The United States government just committed $900 million to build a domestic nuclear fuel supply chain. Uranium spot hasn't moved. These two things cannot both be right for long.
No, they really cannot.
Yeah.
I mean, we are looking at the absolute definition of a market holding its breath right now, just waiting for the physical reality to catch up to the financial moves.
Right. So welcome to this midweek review deep dive, filed Wednesday, July 8th, 2026. If you are joining us today, you already know we are looking squarely at the uranium market.
Definitely. And our mission for this deep dive is to decode this massive, just glaring divergence that's playing out right in front of us.
Exactly. Because on one side of the ledger, we have a physical spot market that is completely stubbornly flat. But then on the other side, billions of dollars are moving into nuclear infrastructure, and uranium equities are surging.
Yeah, it's a huge disconnect. To understand it, you really have to strip away the headline numbers and look at the physical and financial architecture beneath them, because the surface level is super deceiving right now.
Well, let's set the baseline for you guys listening. We are looking at the week of July 6th. The spot price of uranium, which is what buyers pay for immediate physical delivery, is totally trapped.
Very trapped. It's been stuck inside this tiny $1 trading band for over 6 weeks now.
Right. As of Wednesday's close, it sits at exactly $85.85 per pound. And, if you just look at a simple line chart of that spot price, you might easily assume the momentum is completely dead.
Which is exactly the trap that most retail observers are falling into right now. This flat spot price isn't a sign of fundamental weakness. We're actually witnessing is just aggressive consolidation.
Right, because of all the macro factors at play.
Exactly. Think about the sheer volume of events this market has had to absorb recently. We've got the ongoing U.S.-Iran ceasefire talks, the persistent Russia-Ukraine trade, and logistical disruptions.
Just a ton of geopolitical noise.
Yeah, plus major headline volatility across the broader energy sector.
Yeah.
The physical uranium market has basically digested every single piece of that noise and is still maintaining a structurally elevated floor.
Wow.
I mean, even flatlining at 85, we are sitting 12.5% above where the price was exactly 12 months ago.
Okay, so the spot market is consolidating, but the real tell, the data point that reveals where this is all heading is on the long end of the market, right?
100%. The spot price is what you pay today. But term contracts, the agreements utilities sign for deliveries years into the future, those are currently pricing around $93 per pound.
Which is wild. That is a $7 premium on top of the spot price. The long-term buyers are actively showing their hand to the rest of the market.
They really are. It's the critical metric right now.
Let's run the logic on that for a second. Utilities are willingly paying a $7 premium to lock in future supply, rather than just buying the physical material available today. It is essentially like paying extra to reserve a life jacket for tomorrow, rather than buying the one on clearance today. You only do that because you know a storm is coming.
That is a perfect analogy, and we have to remember how utilities operate. They are not hedge funds, right? They aren't speculators trying to flip pounds for a quick profit.
Right, they just need to keep the lights on.
Exactly. Their singular mandate is providing constant baseload power. A nuclear reactor is a multi-billion-dollar asset. If it runs out of fuel, the economic damage is just catastrophic.
So they can't afford to mess around with supply.
Right. So their procurement teams are looking at the supply-demand fundamentals over the next 3 to 5 years, and they're recognizing a severe structural deficit.
Which explains the $93.
Yeah, that $93 term price is a massive vote of conviction. They are saying explicitly that securing the physical material is way more important than fighting for the lowest possible price.
Makes total sense. So if the long-term buyers are forecasting a much tighter market, we need to examine what the supply side is actually building to meet that demand. Because the infrastructure news this week was staggering.
It is massive.
Yeah. On July 1st, just before the holiday weekend, Centrus Energy signed a firm fixed-price commercial contract with the U.S. Department of Energy. The base value is $900 million.
And with auctions included, it totals up to $1.07 billion.
It's over $1 billion. So the stated goal of this contract is to produce high-assay, low-enriched uranium, or HALEU. Centrus is contracted to deliver 1 metric ton of it by March 2032.
Which is a really interesting timeline.
Yeah, and they just finished a successful demonstration project where they produced about 1,900 kilograms at their facility in Piketon, Ohio, doing it ahead of schedule.
Right.
And then this new contract landed on the Monday reopening tape, July 6th, right alongside the news that Urenco USA is bringing its fifth new enrichment cascade online ahead of schedule in New Mexico.
Two massive pieces of enrichment infrastructure hitting the tape on the exact same morning.
It's huge. But, we have to break down the mechanics of what they are actually doing because the raw numbers can be a little misleading.
Yeah, very much so. If we look at the raw volume of the Centrus steel, just 1 metric ton by 2032, in the grand scheme of global natural uranium demand, that is essentially a statistical rounding error.
Right. It doesn't move the needle on global supply today at all.
Not even a little.
So it's a billion-dollar contract for a volume that, on a purely pound-for-pound basis, barely registers. So this isn't about raw volume. It has to be about the specific mechanism of what they are producing, right?
Exactly. It's about the industrial capacity they're building to get there. We really need to explain what HLEU actually is and why it is suddenly worth $1 billion of government money.
Let's unpack the physics on that because I think a lot of people get lost there. Natural uranium comes out of the ground, consisting almost entirely of the isotope uranium-238, which doesn't fission easily.
Right. It's mostly inert for standard power purposes.
So to make it usable in a standard nuclear reactor, you have to enrich it. You increase the concentration of the uranium-235 isotope to about 3 to 5%. That is your standard nuclear fuel.
But the next generation of advanced nuclear reactors, the small modular reactors, or SMRs, they operate completely differently.
How so?
Well, they're designed to be much smaller, much more efficient, and run for far longer between refueling cycles. To achieve that kind of energy density in such a small footprint, they need fuel enriched to between 5 and 20%.
Ah, and that is HALEU.
Exactly. High-assay, low-enriched uranium.
And enriching uranium isn't just like filtering water. You are dealing with uranium hexafluoride gas, spinning it in massive, highly engineered centrifuges at supersonic speeds.
It is incredibly complex engineering.
Yeah, a single centrifuge only enriches the gas a tiny fraction. So you have to daisy chain thousands of them together into what is called an enrichment cascade.
Right. The gas passes from one machine to the next, slowly increasing in concentration. Building these cascades requires elite metallurgical and engineering precision. It is incredibly capital intensive.
So that brings us to why this Centrus contract matters so much. For the last few years, domestic HLEU production in the U.S. was essentially just a congressional science experiment.
Yeah, it was purely a demonstration exercise. What this $900 million contract does is fundamentally change the commitment architecture of the industry.
The commitment architecture, I like that phrase.
Yeah, because the U.S. government is officially transitioning from just funding research and development to actually underwriting a commercial-scale mandate.
So for you, the listener, the takeaway here is how this alters the timeline for next-generation nuclear power.
Absolutely.
Companies like TerraPower, Kairos Power, and TriZo-X, they have brilliant reactor designs, but they absolutely require HLEU to function.
And before this contract, their fuel supply was pretty much purely aspirational. They were just hoping someone would build the supply chain.
Right. But now they have a contractually bound, federally funded domestic supply path. This takes the advanced nuclear sector from being a speculative 2035 story and pulls it forward into a highly visible, actionable 2032 story.
It totally de-risks the entire advanced reactor pipeline. And for the broader uranium market, it proves that the demand models projecting massive future fuel needs aren't just policy talk anymore.
Right. They are backed by sovereign capital.
Exactly.
But, the government funding the future of the fuel cycle is only one half of the equation. We also have to look at what the legacy commercial heavyweights are doing with the assets that exist right now.
And this brings us to Cameco's maneuver this week.
Yeah, which contrasts perfectly with the government's future-facing strategy. Cameco is locking down the present.
The Cigar Lake transaction. It is a masterclass in how to allocate capital when you deeply understand the geology and the long-term price mechanics of your own industry.
It really is. So on July 2nd, Cameco closed its acquisition of TEPCO Resources' 5% stake in the Cigar Lake mine for $115.75 million.
A massive move.
Yeah. This acquisition bumps Cameco's total ownership to 57.418%, with their partner, Orano, taking the rest of the 5% bump. But to understand why this matters, we have to explain what Cigar Lake actually is.
It is basically the crown jewel of operating uranium assets globally.
Truly. The average ore grade at Cigar Lake is 15.6%. To put that in perspective for you listening, the global average for a uranium mine is roughly 0.2% to 0.5%.
That difference is staggering.
Yes, Cigar Lake is over 60 times more concentrated than the global average. You are pulling 60 times the energy out of the exact same bucket of rock, and it holds 172.4 million pounds of proven and probable reserves.
And that phrase, proven and probable reserves, is crucial here.
Why is that?
It means geologists have drilled it, engineers have modeled it, and they have financially proven that the uranium may be extracted profitably under current market conditions. It's not speculative dirt. It's a quantified, de-risked energy bank account.
Which makes the seller's motivation super fascinating. TEPCO is a Japanese utility. We know Japan is aggressively restarting its nuclear reactors and looking to add capacity.
Right. They desperately need stable fuel supplies.
So analytically, it seems completely counterintuitive for a Japanese utility to sell off a piece of the highest grade, most reliable uranium mine in the world right now.
It really does seem backward, at least until you look at the mechanics of utility balance sheets. Operating a physical mine is inherently volatile.
How so?
Well, you're dealing with massive capital expenditures, the constant risk of groundwater flooding, which has historically been a huge issue in the Athabasca Basin, plus labor disputes, and super complex environmental permitting.
Oh, I see.
Utilities are evaluated by credit rating agencies based on predictability and stability. Taking on raw geological risk is just toxic to a utility's balance sheet.
So they are essentially rationalizing their exposure. They are swapping the volatility of owning the physical mine for the predictability of just having a fixed offtake agreement.
Precisely. They want the fuel, but they cannot afford the financial unpredictability of the mining process itself. They are more than willing to pay the markup to a producer like Cameco because it transfers the operational risk off their books.
Wow. Okay. And meanwhile, look at the math from Cameco's perspective. They paid $115.75 million for their 2.87% attributable bump in the stake.
The math is brilliant.
Yeah, against those proven and probable reserves, Cameco essentially bought uranium still in the ground for roughly $5.79 per attributable pound.
It's incredible. They are buying the absolute best rock on Earth for under $6 a pound, while they are simultaneously signing long-term delivery contracts with utilities for $85 to $89 a pound.
Let's talk about a margin. It signals unshakable confidence in both the longevity of the mine and the structural floor of the overall uranium price.
And the broader equity market clearly understood the assignment. Following this close, Cameco's stock, trading under the ticker CCJ, rose from around $97.50 on Tuesday to near $100.93 by Wednesday.
That is up roughly 4% week to date. And keep in mind, this is riding the ongoing momentum of their massive Q1 earnings beat of 38%.
Which brings us right back to our core divergence.
Exactly. Cameco stock is climbing 4% in 2 days. Equity investors are completely ignoring the flat 85.85 spot price.
Yeah, they are valuing Cameco based on their highly profitable contracted delivery business and their ability to acquire Tier 1 pounds for dirt cheap.
Right. The equities are pricing in the reality of the business, while the spot market is just treading water in a $1 band.
The physical market is moving slow, but the financial market is actively pricing in the deficit.
But, while Centrus makes loud moves with a billion-dollar government contract and Cameco makes loud moves consolidating the best operating mine on the planet, the most anticipated news in the entire uranium sector right now is total, absolute silence.
The silence is deafening. You're talking about NextGen Energy's Rook-I project.
I am. Rook-I is the structural pivot point for the future of Western supply.
It really is.
NextGen Energy has explicitly guided the market for a, quote, summer 2026 construction start. For context, Rook-I is the largest undeveloped uranium deposit in the Western world, holding over 100 million indicated pounds.
And because of the sheer scale and the grade of the deposit, once it is built, it will very likely be the lowest cost producer globally.
It's the asset that will fundamentally alter the global supply landscape once it comes online. But here's the thing. We are now in the second week of July. Their June 30th annual general meeting, which historically is the biggest venue for corporate updates, passed without them naming a concrete construction date.
Yeah, they just didn't say anything.
And they already have their Canadian Nuclear Safety Commission license. They have made their final investment decision. The contractors are hired. The capital is sitting there.
Right. They've already outlined that the first 12 months of construction alone will cost roughly 300 million Canadian dollars.
So the money is ready. It's like having a fully fueled rocket on the pad. The astronauts are strapped in. The weather is clear, but mission control is just staring silently at a launch window that is rapidly closing.
That launch window analogy is incredibly apt when you understand the logistics of building in northern Saskatchewan's Athabasca Basin.
Why is that?
Because you are not just building a warehouse in a suburban industrial park. You are dealing with remote, brutal geography. To build a mine of this scale, you have to navigate severe weather windows.
Right, because you are dealing with muskeg, swamps, and really complex water tables. I read that to sink a mine shaft safely without it instantly flooding, engineers often have to use massive refrigeration plants to artificially freeze the ground and the water-bearing rock layers before they can dig through them.
Exactly. You literally have to freeze the earth. And mobilizing the heavy equipment, sinking those shafts, and setting up the initial earthworks requires very specific seasonal conditions.
So the summer window is critical.
Yeah, the calendar is actively consuming that summer window at a rate of 7 days a week. By September, the window for certain critical initial surface works effectively closes until the following year.
So mechanically speaking, if they miss this summer, they aren't just delayed by a few weeks. They could potentially lose an entire logistical year.
Which is a huge deal for capital deployment.
Now, the economics of Rook are completely intact. The permits are in hand. The financing is ready. But the silence itself is becoming a massive market signal. Each passing week tests that summer 2026 guidance.
Because of the sheer scale of the pounds Rookies is projected to produce, the entire Western utilities sector is watching this timeline. It is the single most watched near-term catalyst in the market right now.
This sets up an incredible standoff for the rest of the week. We have surging equities driven by the AI and data center power demand narrative. We have billion-dollar infrastructure plays and massive asset consolidation. And we have a spot price that refuses to break its $1 band.
The total standoff.
So how does this resolve as we look toward Thursday and Friday? What are the catalysts to watch?
Well, we are watching a confluence of immediate market indicators. First, obviously, is the potential next-gen construction announcement. A TSX filing could drop on any given morning.
Right, that could just happen out of nowhere.
Exactly. But beyond that, we have the Friday, July 10th, trade tech and UxC price indicators.
Okay, those are the benchmark reporting agencies for the physical uranium market. We are waiting to see if the physics of a compressed market finally give way.
Yeah, because from a trading perspective, 6 consecutive weeks trapped in a $1 band is basically a tightly wound spring.
Right. That level of compression rarely holds indefinitely. It usually results in a volatile breakout, either up or down once a catalyst hits.
And we also have the Department of Energy's AGU 10 metric ton statutory delivery confirmation to look out for.
Oh, true. The June 30th deadline for this passed without a public press release.
Yes. So with government desks fully operational again this week, the market is expecting a confirmation that actually names the specific advanced reactor developers slated to receive this initial material.
Okay, so if you are tracking the narrative for the end of the week, what is the core mechanism you should be watching?
Honestly, the real test isn't necessarily whether the spot price jumps $3 on Friday. It likely will not move significantly until a named aggressive buyer steps into the physical market and forces the issue.
Okay.
The critical narrative is whether the quiet, persistent outperformance of uranium equities, like Cameco climbing 4%, has a physical, sector-specific reality behind it.
Right, as opposed to just being dragged up by tech.
Exactly. We know the AI and data center power demand narrative is dominating Wall Street right now. Tech giants need 24/7 uninterrupted baseload power for their facilities, and intermittent sources like wind and solar cannot provide that without massive battery breakthroughs.
So capital is flowing into nuclear names as a proxy for power demand.
Right. The question is, are investors just riding the AI macro wave, or are they mathematically pricing in the fundamental reality of the physical uranium deficit?
That is the big question. Let's bring this all together for everyone listening. We are actively watching a market where the physical reality of infrastructure execution is running miles ahead of the actual physical spot price.
Miles ahead.
We are seeing $900 million government contracts turning policy into commercial scale reality, de-risking the future of advanced reactors.
We are seeing incredibly disciplined strategic mine consolidations. Legacy players are buying up the highest grade rock on the planet for under $6 a pound, while utility buyers gladly pass off the geological risk.
And we are seeing equities rise steadily on the back of all this execution. Yet the spot price ticker remains totally flat, just digesting the geopolitical noise.
We are looking at a market of two different realities, waiting for a physical bridge to finally connect them.
Exactly. So I want to leave you with a final, unaddressed reality to ponder as you watch the tape for the rest of the week. We have seen that term contract buyers are willing to pay a $7 premium over the current spot market just to secure future supply.
Right.
But if equity markets, government infrastructure, and utility procurement strategies are all aggressively pricing in a massive structural deficit, well, what actually happens on the day the physical spot market finally breaks its consolidation?
This is going to be wild.
When that 6-week compression spring finally snaps, who is going to be the mystery buyer that forces the physical market to wake up and match the financial reality?
The underlying fundamentals suggest it is entirely a question of when, not if.
Very true. Thank you for joining us for this deep dive. Remember, staying truly informed means looking beneath the surface of a flat price ticker and understanding the mechanics driving the long game. We will catch you on the next one.